Welcome back. This is Chart Overload. I'm Ryan Mumy, the CEO of Sollinda Capital Management, and with me is our Chief Investment Officer, Justin Greenhill. In these, we're going to go through a bunch of charts and talk about what we think about them. Justin, you ready to go?
Do it.
All right, let's look at the big picture. First chart looks at, again, we've shown various versions of this, is the CapEx by major technology firms. And, as we've been highlighting for quarters now, the numbers just keep going up and getting bigger.
Yeah, many billions of dollars being spent. Google, Amazon, Meta, etc., Microsoft, as well as others, just pouring billions and billions of dollars into AI. And this just shows not only the magnitude of the spending, but how much it's increased. So that's obviously nothing new. We've been talking about that. But what is increasingly new is how the market continues to respond to that. And recently it's been giving cloud service providers the benefit of the doubt versus it's been negative on Meta's spending. One of the thesis being is that it doesn't have cloud revenue to participate, benefit, and, lead on in terms of this.
Well, and this money is, it is trickling down into the economy. As we highlighted last year, the first time ever corporate America spending was a bigger contributor to spending than the consumer spending. And it is trickling down into the economy. It's not like it's just being spent and nothing is happening. It's just flowing in different directions, if you will, than historically has been the case. Next chart looks at the percentage of businesses that are using AI, and the different line colors are size of the business. And, as we see here, bigger companies appear to be adopting AI use more fluidly than smaller companies.
Yeah, which makes sense. Bigger companies have additional people, they can take shots on things, and they have more money to spend to try new things versus smaller companies do not. But we are seeing a rise in adaptation from smaller companies as well. So AI is no longer anything close to experimental in terms of if in fact it's going to be adopted by society. It's just experimental in terms of how all parts of society are going to use it.
Yeah, moving from the narrative to the execution, like as different businesses try to find out how they can create efficiencies with AI in their business. It's exciting times for sure to watch it. Next chart looks at NVIDIA. This has been called the flywheel of circular deals, but this does a really good job of laying out who all the players is and how they're connected, and that NVIDIA is clearly in the middle of this circular AI deals.
Yes, NVIDIA is very much at the middle of all services, hardware, et cetera, involved. But the big news is NVIDIA is not backstopping financially this whole thing alone. The company revealed that Wall Street, various firms have come together and pledged $500 billion to support NVIDIA supporting this entire ecosystem in terms of its development. So the big money in the world continues to step up and stand behind this. And, NVIDIA, as seen here, is at the core.
Yeah, and I mean, as this starts to be floated as some sort of, like a national security project, that it's like the AI arms race, more and more firms and resources are going to step up, because if NVIDIA goes down, our edge in the AI technology space would be severely damaged. And, next chart plays right into this. Credit default swaps are the cost to insure against a company's debt. NVIDIA, the cost had went up a lot as they continued to issue some debt. And as you see here, it came down, a lot of it having to do with the news Justin just referenced.
Yeah, so more debt generally, or in many instances, you'll see slightly higher credit default swaps. And this number never was large, got to just over 70 basis points above treasuries. But the news that we just mentioned about a lot of this spending being backstopped this past week arrested that rise and has brought this credit default swaps down a bit.
Yeah, and this next chart is the one before we started recording that Justin and I said, wow, it's shows the number of people who are in a different country who are excited about AI products and services. And, the United States, 4 out of 10, that kind of tracks with what I've seen and experienced. But China, 8 out of 10. I mean, that just double the US. That's surprising.
Yeah, and we think it has all to do with the messaging. Here in the US, you've got government on both sides of the aisle, Democrats and Republicans, at least a good portion of each kind of pushing or identifying a potential negative around it. And you also have the big companies, in particular Anthropic, constantly worrying of these negative things in what many believe is an attempt to kind of create regulatory capture, of the situation. Versus over in China, the messaging from the government and the biggest companies is very positive. AI is going to improve your life, it's going to help everything. And as such, the populations pretty greatly differ in terms of how they view AI. And that could obviously change very quickly.
Yeah, regulatory environment could change quickly. The US, will see it coming. It'll be centered on data centers and communities. There's a lot of hubbub in Western North Carolina over some proposed data centers, as there are around the world, or around the country, excuse me. But, China, the CCP, there's not going to be a vote. It'll just be a rug pull. At any point, the Chinese Communist Party could clamp down on AI. And that's the unknown, is the regulatory environment. And it looks vastly different between the US and China. Moving on, U.S. producer price inflation. That was a new release this week, and it came down. It was lower than expected. Not just the headline level, but also the core, which excludes food and energy, which is a positive.
Yeah, and ever since the new Fed chair has come in and claimed at least to want to be very hawkish in terms of, fighting inflation and so on, the market has become even more focused on the inflationary data, of which recently has undershot what was consensus expectations. And that's what this shows here in what is core PPI. Basically came in less than expected, and no surprise, that was a big risk on day across markets when that came out this past week, because a lot of what has been risk off, has been, at least in part, a result of kind of fear that there would be a new rate hike campaign because of inflation. And thus far, that inflation hasn't materialized.
Yeah, that was a big headwind. One of the wall of worry, a big contributor was inflation as a result of the Iran conflict, war, whatever you want to call it, and that high oil prices bleeding through to the rest of the economy. And this data just shows that for at least the last couple ratings, it's come down quite a bit, which is, helpful to the overall economy. Next chart looks at trade deficit, and this last one was a big one.
Yeah, I mean, many of them have been, and this last one was, especially big as well. So the deficit continues to grow to levels that were previously unimaginable. And I guess what's interesting to kind of think about is really both sides of the political aisle in the US, Democrats and Republicans, have now, what factions that used to be negative to the deficit have now been largely silenced. And one of the reasons is there's not been any repercussion that society can identify and attribute at this point. And as such, they kind of continue to spend, and all indication is that that's going to ramp up ever higher as the US needs to retool the military as we go into the election cycle for the midterms, so on and so forth.
Yeah, it just hasn't mattered, and at some point it will, but no matter, as Justin said, these unimaginable levels, but it really hasn't mattered as of yet. Next section, domestic stocks, earnings, back to the spending of CapEx. Earnings have been, remarkable. They've went up substantially the last 2 quarters.
And what's been, even more notable about these strong earnings that have come in well above what were already positive, strong expectations has been the fact that, earnings in terms of the base effect were also strong. So unlike during the COVID period where earnings accelerated from what was a dramatic, short-lived collapse, this has been earnings accelerating from what was already a strong corporate environment. So very notable, to say the least.
Yeah, and it's not just headline gross, earnings, right? It's the net, this next chart, net income, if you will, margins, net income has went up as well.
Yeah, which, some of that could be efficiencies companies have generated from AI. Some of it could be the fact that, they're using less employees. I mean, there's a lot going on there, and just the fact that, the biggest of big companies do have pretty strong pricing power, which just goes to the fact that there's been, durable demand within the economy, at least for S&P 500 goods and services.
In next chart, it's been in the news about the U.S. stock market being at unsustainable levels, being overvalued by some measures. There's lots of ways to look at that. The one that people have been talking about is the Case-Shiller CAPE index, cyclically adjusted price to earnings ratio. But this shows valuations have come down substantially relative to the rest of the world, to the point where they're below their long-running historical average.
Yeah, this has everything to do with the fact that in terms of the S&P 500, earnings have gone up this year much more than the price. So you've seen that bring price to earnings lower. But then outside of the US, you've had Europe, Japan, Korea, all seen pretty substantial price increases in their stock markets relative to their respective earnings. Their earnings have also grown, but it's been the opposite in terms of that relative dynamic. And the net is that no one can any longer, at least on a 10-year look back, say that U.S. stocks are richly priced relative to the rest of the world, because that's just no longer the case.
Moving over to the interest rate section, the first chart looks at the Fed's projected policy, rate policy projection, the yellow line being their own dot plot, and the other two lines being market's anticipation of where the Fed's going to go with interest rates.
Yeah. The dot plot, just a caveat, new chairman Warsh does not participate in the dot plot, as he's attempting to really rein in and potentially eliminate that, I guess, forward commentary that the Federal Reserve often does in terms of where they see interest rates. But nonetheless, you can see that the market expects there to be more rate hike than what the Fed is claiming they expect there to be. But nonetheless, that's only expected to be one rate hike of 25 basis points between now and the end of the year. And that expectation, which you'll see here in the black line, has dropped from what was the gray line on this chart following the aforementioned lower than expected inflation PPI reading.
Moving on to the next chart. Again, this has been in the news. The U.S. 30-year auction of our treasuries. It was a high rate, north of 5%, which is a big number. And that used to matter, right? Like 5 used to be the number where people started getting nervous. And as Justin and I have talked about and shown, like it's been a nothing burger to market participants thus far.
Yeah. And buyers of U.S. bonds, be it domestic buyers, banks, individuals, or be it foreign buyers, sovereigns and non-U.S. corporations, the simple explanation is they're just requiring higher yields to stimulate that demand to buy, which makes sense when you consider the graphic we showed on the deficit, but it also makes sense when you consider just the amount of stimulus and CapEx that is going into the economy. And historically, across all countries, that is usually associated with higher yields. So what could change this quickly is, either a substantial drop in inflation due to some sort of economic slowdown or policy intervention.
Or a recession. But again, not likely. And again, something that's interesting, we were talking about it before we recorded, was there's no data in the left side of this chart, and that's because the U.S. government in 2001 suspended the issuance of the 30-year U.S. Treasury because they had such strong surpluses that they didn't feel they needed to issue long-term debt, which is just mind-boggling considering the deficit information we just looked at.
I mean, in the case of a recession, COVID doesn't count. So there hasn't been a proper business cycle recession going all the way back to the global financial crisis. There was a earnings recession, I guess you could say. I believe it was in 2015 or so. But, and there was one across some of the economy in 2022, but an economic slowdown, negative GDP, we've not had it. And it's hard for that to happen when you've got this much stimulus, be it from the government and now from the private sector, going into the economy.
Moving outside of the U.S., going on the tour, this looks at the Euro Stocks Index earnings per share. And, it's not just a U.S. situation. Earnings are increasing around the world.
Yeah, and as you can see just from this chart, the year over year earnings per share of European companies is much more volatile than what that same chart was for the S&P 500. And a lot of that has to do with the fact that these companies are traditionally more cyclical versus the S&P 500 has had, your network providers that are now, called hyperscalers, and much more to do with kind of like secular earnings growth companies. But having said that, back to the fact that US companies, smaller ones, are adopting AI, there is a large AI adaptation happening in Europe as well. So it is possible that what was very relatively cyclical earnings seen here in European stocks could actually over time start to look more like the earnings profile we see in the US.
And it's not just the US and Europe. This next chart looks at Asia. This shows earnings per share upgrades being the largest since 2009. So again, earnings are accelerating around the world.
So, Japan, Korea obviously has been a big driver of this is they've been, at the epicenter of the kind of the memory crunch and the beneficiary of that. But yeah, I mean, the takeaway is when you look outside the US, non-US stocks may not be as cheap relative to US stocks as they've been, but non-US stocks are having some of the best earnings that they've had in a very long time.
And then there's Brazil. This next chart looks at Brazilian stock exchange and then also the US dollar to BRL, the currency pair. And as you've seen, there's been some pressure here recently.
Yeah, and it's important, we want to try to at least generally, if not more deeply, understand kind of the differences between not only the economy of these countries, but the actual stock market and what the stock market represents. And we mentioned that the US is very much, secular earnings from technology and so on. Europe is a bit more cyclical. Asia has obviously experienced a big pickup in earnings from AI and technology. We talked about Korea. Brazil, on the other hand, despite being a very big economy, the stock market is very much traditionally cyclical. So miners, oil, banks, etc. And a lot of what those companies do in terms of their performance requires there to be, positive sentiment because foreign money needs to flow in there. So what we're seeing here is the fact that there's a big election coming up in October, and it went from quite a bit of stability to quite a bit of volatility over the past week or so, just as people start to take some risk off the table going into that election.
Yeah, and the next chart shows a big chunk of some of this risk off in Brazil was foreign investors. They saw the largest outflows since 2021.
Yeah. So it's also important to keep in mind that foreign flows into Brazil are almost always going to be driven by what is perceived in the macro, what is perceived in the currency, et cetera, much more so than foreign money is going to be coming after a unique earnings profile across the companies. So very different than how we see in the US and some other jurisdictions. But with all that factored in, there is a pretty significant wall of worry being built up into this election. And the stocks are relatively cheap. Interest rates are relatively high or very high relative to the rest of the world within the country. And it's one of those scenarios where the market might get overly worried and things might just continue to be exactly the way that they are post this election. And looking back to the US deficit, et cetera, the biggest threat to Brazil is a sustained period of time of US dollar strength combined with just the inability to get any sort of improvement on what is a pretty tumultuous fiscal situation inside of Brazil. So those are all things worth paying attention to there.
Moving on to our last section, commodities. So this first chart just shows that weaker than expected U.S. inflation, not only easing pressure on the Fed to hike, it's having a rippling effect around other markets.
Yeah, so after having a unbelievably rapid and dramatic run higher, precious metals, in this case focusing on gold, had a pretty big multi-month correction up until recently. And then what's happened over the last couple of weeks has been as, inflation data has come in less than expected, as the market has worried rate hikes and so on. You've, now seen precious metals and metals in general kind of boost back. So gold running back into what are key moving averages there seen in the chart.
Next chart looks at oil. We've been talking about it a lot as it's been in the news with the Iran situation and the Strait of Hormuz. It ran up, it came down, it ran back up, it came down, and now it's, settling in what's been kind of a range around a lot of its moving averages.
Which is, stabilizing higher than it was prior to the conflict, but well below what were the highs at the initial phase. So this is something kind of worth paying attention to, but similar to what we're talking about with bond yields, it's seemingly being less about the level and more about the volatility or the speed in which the market reprices to a new level. So if things just kind of hang out here, we would sort of expect volatility to drop. And in terms of kind of looking at clues about just the physical oil market, if you were to go below the surface and look at the forward curve in oil, you see that front months are still trading at a premium to months further out in time, which just means there is a relative supply crunch, in the near term, and the market's expecting there to be a return to normality further out in time. But with that structure in place, that is very much a structure of a market that is unlikely to see oil prices collapse. Historically, you need to see the term structure go back to the other, front months being cheaper than further out in time. That is a characteristic of a steady decline in oil prices, and we're not there yet.
And, to your conversation, volatility in oil, that's, the next chart, which obviously that's changed quite a bit over the last year.
Yeah, it's interesting. Like, so this chart is basically kind of showing that oil volatility being low was kind of negatively correlated to prices, which just would basically mean that, as oil volatility stays subdued, you don't necessarily have that being a positive impact on prices. If anything, that, back to the prior comments, just sort of puts a headwind to oil. Versus of late, we've seen oil volatility spike up to be positively correlated. So higher volatility, higher prices, which, makes sense. And I think the takeaway from this chart is there is ample room for volatility to drop back and those correlations to return to what they were prior to this recent conflict.
And the question remains, where does oil settle? Going back to the previous chart, it was in the mid 60s prior to Iran. It shot up, and now it's settled in the, I don't know, call it the upper 80s, around 90 a share. Where does it settle back in? It doesn't even have to get worked out over there, but it works back to the normalization, if you will, of the oil market. What is that level? As Justin pointed out before, that matters as much in anything because oil volatility comes down.
Well, just to hit on this a little bit more, we talked about it, I think, in a few videos past, but the depletion of strategic reserves, in the US of oil, the fact that China really slowed their imports of oil, and the fact that producers like Brazil, for example, have really stepped in to supply oil to the market, have very much kind of helped keep prices from spiking tremendously and, put them off of what were their initial highs. But there was also a lot of commentary out this past week talking about how now they're starting to think that there has been and is more oil moving through the strait than was believed to have been based on what was prior to the data. So it just really goes to show that, a few weeks ago or a couple months ago, Ryan, you and I joked about this, that the bear case was, the market just doesn't appreciate what's happening with oil yet. Well, it turns out the market was right, and people thinking there was no traffic going through the strait were actually less informed than what the price of oil was, which would make sense in a global market with that much liquidity, right? That it's going to be able to kind of sniff out fair value pretty efficiently despite bursts of volatility.
Moving on to some of the metals, this is a price chart on copper, and I mean, up and to the right. Right.
Yeah, with a good amount of volatility along the way, but definitely a trend. And we've talked about copper used to kind of be the bellwether of industrial demand due to Chinese infrastructure in particular, but global infrastructure in general. But now it's become kind of much more of a barometer of what's happening with AI, as it's a key component in a lot of different things technological, be it batteries, data centers, and so on. But up and to the right. So we would call this a trend.
Yeah. And final chart, this just looks at copper to gold. We talked about gold, we talked about copper. This just shows their relationship. And, gold was outperforming copper for a long time. And then AI happened.
Yeah, and what's interesting too is both have over the last several years gone up a lot. So looking at the ratio just sort of, I guess, takes that out of the analysis. But yeah, I mean, you could say that copper hasn't yet gone up as much, and obviously copper has a pretty challenged supply outlook that many think isn't fully reflected in prices yet, because there's been a lot of near-term supply of securitized copper that has been able to come onto the market. And as the AI build out goes on, copper could become in pretty short supply relative to demand, versus gold is, I can't ever remember reading anything about the supply side of gold being a variable. It's all about, demand in terms of what sentiment is. And again, back to our prior comments, a lot of that most of the time has to do with the rate of change of real interest rates, the deficit, the dollar, et cetera, versus copper is very much industrial demand centered.
That was this chart overload. We appreciate you tuning in and listening to us. We'll be back in a couple weeks to flash some additional charts and talk about what we think is interesting. If you'd like to talk about any topic whatsoever, pick Justin and I's brain. We love what we get to do every day. Reach out to us at info@sollinda.com, info@solinda.com. Again, we appreciate you tuning. Hope everybody has a great week.